Okay, I want to get into this diagrammatical representation of investing is a positive sum game, but a zero sum game around the market return. I'm going to remove my face. Just makes it easier for me. This is a diagram I got from Vanguard. It's on Vanguard's website, somewhere on Vanguard's website, but they make a mistake. They say investing is a zero-sum game. That's just simply not true. Investing is a positive-sum game. And this is represented in this diagram by this line here. This is the market return, market benchmark, whatever you call it. You can define market any way you want. The market could be all Canadian equity. It could be all Canadian equity and all Canadian fixed income. It could be the ultimate market is every single investable security in the world. So define it how you want. It could be the S&P 500. Let's go with S&P 500. Okay, so market benchmark, market return. Here's the return of the S&P 500, and this is, in the long run, this is a positive number. Now, there are fundamental reasons for that. There are fundamental reasons why the market grows in the long term. We human beings get better at what we do over time and generations, and companies continually reinvest in themselves. When a company earns a profit, what do? They give some to shareholders in the form of a dividend, and they reinvest the balance. So markets grow in the long term. There's no getting around that. Only a politician, only bad public policy can ruin this. Think Venezuela. Okay, so let's say this number. Let's say the market grows by 7%. Investing is a positive sum game. Every single investor could get 7% before cost. Every single investor can't get 8% before cost. Or every single investor couldn't get 6% before cost. Every single investor, the market has grown by 7% in our example. There is a distribution of returns around 7%. We're calling this number 7%. Okay, so notice that the distribution around the market return is a symmetrical number. For any dollar that outperforms here, there has to be a dollar that underperforms. So notice that half the money is on this side of the line and half the money is on this side of the market return line. And this is all pre-cost. Now, let's take the group of all investors and divide it into two. And you have the group of passive investors and the group of active investors. Well, we know by definition that the group of passive investors gets the market return before cost. We know that cost is low for passive investing. So what do they get? Every single passive investor theoretically gets this red line. Let's say the market goes up 7% and the cost to each and every passive investor is 15 basis points. Well, their after cost rate of return is 7 minus 15 basis points equals 6.85%. That's their after cost return. Now let's look at the other group, the group of active investors. Okay, we know that the cost to deliver active investing is more expensive than the cost to deliver passive investing. So that's the difference between here, the red line, and this line. This is the after cost return to the group of active investors. Now, unlike the group of passive investors, not each active investor gets this. There is a symmetrical distribution around this line. Some will earn a rate of return over here, some will earn a rate of return over here, and exactly half the money invested actively must be on this side of this after cost market return to the active investor. So, this tells us that the group of passive investors always outperforms the group of active investors. Now, there's three groups within the active investing group. Those that outperform pre and post cost. You know, in our example of 7%, let's say these guys get 9%. Let's say this cost factor here is 1 full percentage point. So they get 9% pre-cost and 8% after cost. There's this group here. They outperform pre-cost and underperform after cost. So let's say they get 7.5 pre-cost and 6.5% after cost. And then exactly half the money invested in the active group must underperform pre-cost, and cost makes it worse. So for the active group, cost shifts the curve left. So that's this big shift. Now, there is no curve for the passive group because by definition, each passive investor gets the market return pre-cost and gets, the same market return less the cost after cost. So that in this example, 7% pre-cost, we're saying cost is 15 basis points. Each passive investor gets 6.85% after cost. Now, this is theory. Obviously, there's variability in cost to the passive and to the active investor, but I'm saying 15 basis points. And I will say this, if you're invested passively and your cost is above 15 basis points, you should be looking around because you are paying too much. Anyway, I'm going to leave that there. Thank you. Have a good day. Onward and upward.